This is what I call the financial freedom formula. As mentioned earlier, for those of you who were on at the start, this is what I got taught when I first started looking at property many moons ago. And it's what I've taught to a lot of my personal students, and now we're sort of scaling it out across part of that core Wealth Mentor curriculum. So I first learned about this from Steve McKnight. In fact, I was working in Australia. I did what all Kiwis do, right? We go to Australia because it's easy money. Worked on the mines, worked on the oil rigs, made a lot of money, spent a lot of money, but it was through that someone handed me Steve McKnight's book, From Zero to 130 Properties. Let me know in the chat. Has anyone actually read that book? It's pretty old now. Some of what we'll be sharing later will be strategies Steve actually did. He didn't teach them to me. But yeah, it's following on from those strategies. He's also the founder of propertymessing.com. He's purchased well over 500 or so properties throughout his investing career. And this was the exact strategy he taught to me 2012. Interest rates came down so low that you almost didn't need to, because anything you bought was cash flow positive. But now that interest rates are high again, I actually think what he taught right from the get-go was bang on. Hence why we're rolling it out through Wealth Mentor. So building wealth itself is actually really simple. Simple, not necessarily easy, but simple in concept. As long as you spend less than you earn, now you're saving money. If you start investing those savings into growth strategies, now you're growing your money. And then if you either sell down or leverage those growth strategies and take that cash or equity and put it into cash flow strategies, well, now you're getting a passive income, right? Many of you will understand the fundamentals of it, but we've never actually talked about it from that step by step process. So this is how you work it out. Passive income simply equals your capital divided by your return on investment. And so if you want to increase your passive income, you either need to increase the amount of capital you've got, or you need to increase your return on your investment. And this is where I say, and I'll really do a full session on this tomorrow, but actually managing your money, not just being an investor, but managing your money, doing regular portfolio reviews. In fact, you should be doing a portfolio review every single year, and checking in with your mentor. And, again, that's part of the benefit, I think, of being in Property Club, because it's now happening every week, right? But yeah, really focusing on how you're both growing your capital and what is the best return on investment that you can possibly get. So those are the two key things that you need to look at. So to put it really simply, if you want $100,000 of passive income and you can invest that at a 10% ROI, then you only need $1 million in capital. And as we know, $1 million in property, relatively easy, right? Some of you are already there right now. Some of you are even over that. And yet this one simple restructuring of your portfolio could be all it takes in order to become financially free right now. So if we talk about growth strategies through property, renovations to add value, anything you can do to add value, right? Renovations or subdividing, all add value. Developments and construction, all adds value, increases the value of the property. Market capital gains, so this is where you don't do anything, but you're deliberately targeting a market which you believe or is experiencing capital growth, and there still are markets across Australia and New Zealand where that's happening. Flipping, where you're taking a property, you're buying it, you're adding value to it in some way, you're selling it, and you're actually realizing that capital gain in the form of hard currency back into your bank account. That is a growth strategy. Increasing rent is a growth strategy. Why would increasing rent be a growth strategy? Because you're capitalizing on those increased income streams. So anything you can do to increase rent, just even simply putting the value up, is going to add value to your property. And then, of course, refinancing equity out is a form of releasing that growth that you've had within your portfolio. So these are all the different strategies that we can look at within property in order to grow the pool of money that you have. Obviously, one of our favorites is the buy, renovate, refinance, recycle, and then either go again. But you could also do it where you're now investing into cash flow strategies. And when I say this, right, what I'm saying is still adhere to your buying rules. I'm not saying go out and buy like negatively geared properties that you think are going to go up in value, right? It's saying follow your rules where you're still buying cash flow positive properties from the get-go. But if you're doing it in a way that you're able to pull money out and start putting it into cash flow strategies, for example, commercial, mortgage-free commercial property, something which is getting you 10+% returns. And the reason why we say commercial property is simply because on a commercial property, the tenant pays pretty much all the outgoings. So if you've got no debt against it, you've pretty much got no expenses, really. Looking at multi-unit properties, for example, and unencumbering them, boarding houses with no mortgages, doing joint ventures with the cash that you've freed up, where now you're the money partner and someone else is going and doing the deal and you're getting a percentage of profit, or angel investing. And we've got a number of people in here who are doing those exact strategies right now, where they're able to actually now release the capital they've made either from flipping properties or release the capital that they've made from refinancing out of their existing portfolio in order to go into some of these different strategies. But there's also a number of other strategies that you can be looking at, and just off the very top of my head, I threw these out from real estate investment trusts, which average 10%-ish, structured notes, which you can get 14 to 15% on, dividend stock, which completely ranges and what you can get from that sort of 3% all the way to about 10%. Dividend aristocrats, so these are a very interesting type of stock where they might be low now, but every year the dividend on them increases. So they pay out more and more and more every single year. From crypto staking and yield farms in the Web3 type area, where you're starting to look at, just even 20, 30, 40, over 100%. Bank interest, which I believe at the moment is about 6%. Looking at foreign property where, I'm investing in America with some of my cash, where I'm ranging 10 to 11% return on my money. And I know some of the mentors, Helen, for example, has invested in the UK as well. So some of these other strategies, and this is where we say you're not just a property investor, you can utilize property in order to build the nest egg and build that capital, because it's really easy. You buy a $500,000 property and you increase the value by 10%. Well, you've just made $50,000, right? Very easy to build capital and make money through property, but cash flow at the moment, a little bit harder. So you might be thinking about what some of these other cash flow strategies are